Seeing a bit of a bounce today, but just given yesterday's reaction, I think a lot of people are wondering, are we in a second leg of a bear market? Bernstein says we still have further to fall, having analyzed historical routes and found that on average from peak to trough, it's really a 28% drawdown versus the 20% we've seen so far.
Yeah, thanks for having me. We think this is still a bear market rally and that the market could have further to fall. So we've had a 3,600 year-end target on the S&P 500. When we look back at what we call bull market signposts, that we've got about 10 signals that we look at where, most of these usually occurred before the market entered a new bull market. The majority of those still haven't been signaled. So 6 out of the 10 are still suggesting that this is just part of a bear market rally. Usually the Fed actually starts cutting before the market bottoms. And when we look at what we call the rule of 20, which is that, CPI, inflation, and then the trailing PE ratio for the market, should equal about 20 or be below that. Right now we're at about 27. So, the market PE is still very, very elevated. And so we expect we could see, further downside risk to equities from here.
So then what should investors do on days like today where they do experience a bounce? Would you recommend maybe crystallizing just some gains, getting more into cash?
So we think there's still opportunities within the U.S. equity market, and rather than buying the S&P 500, which we've actually felt has had more risk than some of the other benchmarks, we think that small caps are one area of opportunity. They've been much more adequately discounting the risks of recession, where we are forecasting at B of A, a mild recession we could see early next year. Small caps are trading at more than 20% below their long-term average multiples, whereas large caps are still expensive. Small cap equity risk premium is at record levels, and they're really benefiting from fundamental trends we see within the market right now. A capex recovery in the U.S., reshoring of U.S. manufacturing, where we're seeing more and more evidence of that. Services spending doing better than goods spending. So we do like small caps, and we also like value over growth. Value is still relatively under-owned, relatively inexpensive versus growth within both large and small caps. So we'd stick with value. Value and small caps both tend to work within the later stages of late cycle markets, where we think we're in one of those today. And in terms of sectors, energy still ranks well within our work within both large and small caps. Healthcare ranks well within our large cap work. That's a sector that looks a little bit different in small caps and where we're more cautious. And lastly, we'd say, pick stocks. We think it's a good backdrop for active managers, a lot of valuation dispersion and opportunities out there. Within small caps, that's true as well. Our analysts at B of A cover over, 900 small and mid cap stocks. So we think it's a good environment to buy things other than just the S&P 500 index.
Yeah, it's been interesting. B of A, as you say, been net cautious for a while now, and actually before it was popular, and it's actually served a lot of investors well. I do wonder, Europe, your view on that, and if you think the market narrative has been moved at all by either their progress on energy security or the counteroffensive by Ukraine.
Well, I think, overall we've been cautious on equities in the U.S. and have taken a cautious view in Europe as well. I think from, to the point about energy security, I think that energy has been a huge topic this year, and that ties into a lot of the work that we do on ESG, where, this year you saw somewhat of a reversal in terms of inflows into ESG strategies as a lot of investors focused on energy security. But that's been one point that we've been talking about in our ESG work, is that a lot of ESG investors have been underweight areas like energy and defense. And we think that, being exclusionary and excluding these areas from those types of strategies can actually, hurt these investors' performance. And so we would advocate more inclusionary strategies with respect to some of those areas.
Yeah, this year and last year definitely showed kind of the full extent of what divestitures can result in terms of returns. Thank you so much, Jill. Appreciate it.